Morning, Alistair.
Good morning, James.
I've very much enjoyed reading your latest article on Goldmoney Insights, and I really look forward to speaking to you about it. I thought it was an excellent article. I would like to dig deeper into the insights that you had in that article and what you labeled a currency revolution. You referred to an article by Zoltan Posar, who's an analyst for Credit Suisse, but you actually had different aims. He was speaking to commodity traders and how to deal with the inflationary environment, but you approached it from a much more strategic point of view and what the implications are for currencies. Now, both you and he were talking about financialization of commodities, but you went a different way in terms of the impact in applying it toward currencies. Can you sort of explain a little bit about what you meant for those people who haven't had the opportunity to read the article?
Yeah, it's interesting because I think Zoltan Pozar was basically, he is probably one of the top analysts understanding, sort of Fed policy, the ins and outs of, money, as it were, in terms of, that sort of very high level of sort of Fed policy, the reaction from banks, what the various instruments are, and things like, what spreads mean and so on and so forth. Now, that is a specific skill, and I wouldn't claim to be as clever as him in doing that. My objective was somewhat different, and that is to put it in an economic context, which so few people really do. And in this age of Keynesian economics, very, very few people actually, it seems to me, understand the economic implications of what might be happening, and particularly at this juncture with currencies. I thought Pozar put it really very well, in the sense that he said we've had Bretton Woods 1. Bretton Woods 2 was when we sort of went off any form of gold standard, and that has gone right through until now. And now we're on the edge of Bretton Woods 3. What he means by that is that we are moving out of the current situation whereby currencies and banking rely on financial assets as collateral behind both the banking system and also the whole currency system, into something different. And that something different was really brought about by sanctions against Russia, or at least highlighted by sanctions against Russia. Because what Russia has effectively done is she has commoditized her currency. It seems a sort of funny way of putting it, but basically what she has done is she has turned around and cast herself adrift, if you like, from the financial world that we all inhabit in the West, and in effect said, right, the ruble is going to be tied to our commodities. It's the strength of our economy. That's where we are. And there's some very good reasons for this. I mean, apart from anything else, if you just stand back and look at our current situation, there's been an awful lot of expansion of the quantity of currency and credit in circulation, particularly since the Lehman crisis. And that is beginning to undermine prices in ways which really the central banks don't expect. So we're now in the situation where we can see that prices for commodities, goods and services, producer price inputs and all the rest of it are really sort of soaring out of control. And that was before Russian sanctions. So, what does all this mean? It means that we're going to see, quite naturally, interest rates rising significantly further than anyone currently.
We're seeing that already. I mean, the T-bonds are literally crashing.
Exactly, James. It's just beginning to come through. I mean, we're seeing, I had a look at global bond yields this morning, and without exception, they are all up. And if you look at the yield on the US 10-year Treasury, I mean, it's taken off. But if we have prices, consumer prices rising, say, at 9%, and we've got another one coming out, I think, this week, then is it really appropriate to have a 10-year Treasury bond yield at 2.75%, which is the current level. No, it hasn't caught up with events. And again, we're talking about the situation before the effect of sanctions. And the effect of sanctions has basically been to drive up commodity prices even further. So what I was trying to do is put myself in the shoes of the Russian state, if you like, or the Russian central bank. And I think that, I mean, they've already got interest rates up at 10%, something like that. But their salvation has got to be from a stronger currency relative to the currencies of the Western alliance. And, that way they protect the domestic economy. They ensure that, inflation remains under control, inflation in the sense of rising prices, and so on and so forth. But the interesting thing is that it's not just Russia. I go back to 2020, in March that year, when the Fed raised its level of QE to 120 billion a month, and it cut the Fed funds rate down to the zero bound. Literally within a month, China had analyzed this and decided that this was basically inflation on steroids.
Time to buy commodities.
So they began accumulated commodities. And the interesting thing is that one of the commodity groups that they really started accumulating was grains. In that sense, taking Ukraine and the Russian steppes out of world grain production has just made the situation a whole load worse as far as the rest of the world is concerned. So, with China having originally gone for grains, realizing that the inflationary effects of monetary policy were going to have severe repercussions on its own population, they needed to protect it. I mean, the situation's got a whole load worse. So China has, for 20% of the world's population, something like 70% of the world's maize, something like 70% of the world's wheat stocks. It's got something like 70% of the world's rice stocks, and I think around about 35% of the world's soybeans. So these are fundamental food factors. And the rest of the world, really, as far as this Ukrainian situation is concerned, can just go hang. And this is going to be a real crisis later on this year. So you can understand why China and Russia are protecting themselves from the consequences, firstly, of what the Fed was doing way back 2 years ago, and secondly, from the consequences of the sanctions, which has just made the whole situation a whole load worse. And that's roughly where we are. And that was the point of the article.
You used the term currency revolution. So what you're suggesting is we're moving to a bipolar or perhaps a multipolar financial world away from the US dollar. Is that your basic conclusion?
Yeah, absolutely. I mean, the whole basis of the dollar, of the pound, of the euro, and the yen is financial assets, and particularly government securities. I mean, government bonds. Now, if we have, as I suggest, interest rates rising substantially, then what's going to happen is that the value of those financial assets as collateral is going to collapse. And it'll take with it, I mean, it hasn't really happened so far, but it will take equities with it. So the whole of the Western financial system is being undermined by the consequences of, first of all, Fed policy, which has just, printed money like billio, or currency rather like billio. And secondly, the response from Russia and China, which is to try and protect themselves from this situation, ending up driving commodity prices even higher. So, this is a situation where, on the one hand, you can see the escape route for Russia and China, but on the other hand, we must not underestimate the effect on financial assets within the system. It is a bubble. I mean, the whole idea of cryptocurrencies and all the rest of it, this is all stuff that you get at the top of a financial bubble. That's where we are, and that's what's bursting.
Yeah, but interestingly, we would suggest that it's going to be a decreased demand for the dollar. But ironically, the dollar index has hit 100 today, where it hasn't been for many, many months. So, talking about the impact on the West, it's having a different impact on the euro, the yen, and the other currencies rather than the impact on the dollar right now. So is it going to be like a two-step approach? Eventually the dollar will be hit as well?
Yeah, I mean, basically, to look at the dollar's trade weighted, I think is actually looking at the wrong thing, because all these currencies are now sinking, but they're sinking at different rates. And
sinking in terms of purchasing power, they're all losing.
In terms of purchasing power, exactly that. But the thing that's fascinating is that in the month of March, if you look at what's happened to the yen, that really has collapsed. And I think it's the beginning of a collapse rather than just some sort of market readjustment. And the reason I say this is that if you look at the situation for the Bank of Japan, they started doing QE as long ago as 2000. I mean, this is, we're now in the 22nd year of Japanese QE. Their balance sheet is absolutely loaded with Japanese government bonds, Japanese corporate bonds, and even equities in the form of ETFs. And their current starting point is from negative interest rates. And their problem is that as the yields on their portfolio starts rising, it means that the value of the portfolio starts collapsing. So what the Japanese central bank has done is it's turned around and said, we will ensure that the yield on the 10-year JGB does not exceed 0.25%. Put another way, and putting it very simply, they're going to protect, try in this easy inflationary times to stop government bond yields at the expense of the currency. And that's basically what's happening. That is why the yen is going down. Yeah. And it's a similar situation for the ECB in the Eurozone. Now, it hasn't quite hit it in the same way yet. I think first we're seeing it in the yen, then we will see it in the ECB. But I mean, the whole of the Euro system is, it's a barrel load of rotten eggs. I mean, if you look at the ECB's balance sheet, that is already in negative equity. All its shareholders are the national central banks. They're all in negative equity. If you look at the commercial banking system, that has an average asset to equity ratio in excess of 20 times. And in one case, there's one of the global systemically important banks is up at 30 times. I mean, this is real bubble stuff.
So
how do you sort that mess out?
Let me bring us back to commodities again then, because what we're actually talking about, I guess, is the difference between tangible and intangible, between real commodities and paper promises. Yeah. And then when you look historically at, monetary history and bubbles, it's these paper promises that get inflated to such an extent that they become doubted. And me being an ex-banker, I'm very sensitive to this whole issue of counterparty risk. So basically what you're saying is that counterparty risk is going to be increasing as we become more and more commodity oriented. Is that one of the basic conclusions?
Yeah, absolutely. It is inevitable. And the thing that's interesting is, if I can go back to Russia for a moment, one of the earliest announcements that the Russian central bank made was that they would be prepared to buy gold at 5,000 rubles per gram. Now, at the time that announcement was made, the price was well above that level. What happened was that the strength of the ruble then brought the price down to, sort of the level at which the bank was prepared to buy it. They then changed that and said, well, we'll negotiate it on a case-to-case basis. But the sense in that, I think, was very, very well illustrated by a chart you had in your book of the oil price over time from, just going back to 1950 and indexing the lot at a base of 100. I mean, in the price of gold, we spoke about this the other day. The current level is, if you like, in those index terms, is down 30%. Oil is down 30% from where it was back in 1950. But if you look
at the purchasing power of gold is 30% higher than
it has risen, exactly. But when you look at it priced in paper currencies, it's a nightmare in terms of what's happened, and also the volatility of the prices is considerably greater than gold. So I think a conclusion we can draw from that is that if you want to have a general link into commodity prices, in other words, a means of escaping, the sort of Western profligacy with their own currencies, then actually the best way to do it is through gold, because gold will reflect always some sort of steadiness, if you like, in terms of commodity prices. So this, if you like, is the escape from collapsing Western currencies. I mean, we're beginning to see the collapse in the yen, as we've just discussed. I think the euro is next. And I can't see how this can be avoided by the dollar. I mean, just think, if the Fed is going to have a problem that as interest rates continue to rise, as the pressure continues, do they rescue the economy, which is tanking? Do they rescue the government finances, which are tanking, by suppressing the rise in interest rates as much as they can? In which case,
something's got to give, though. If you suppress the rise in interest rate, then you're going to create more inflation and weaken the purchasing power of the dollar. But to put some numbers to this, the U.S. government federal debt now is 30 trillion. So if interest rates raise 1%, that's going to add 300 billion a year. That's approximately 8% of the revenue that the government receives every year. And they're not going to cut back spending in other areas. It's just going to widen the deficit, which means that there'll be even more debt and therefore higher interest rates. Yes. So imagine, 5% interest rates, let alone what Volcker did back in the 1970s in order to bring the dollar back into a stable position and to save the dollar, 15% interest rates. It's an impossibility.
So that can't happen. Yeah,
it's going to be,
can't happen
unless you have hyperinflation, or one of the points that I've been making is that we're just going to have more financial repression, which means less liberty, which we don't want to go that way either. So, no. I mean, it's a real dilemma. I want to go back to a point you're making about, gold and related to China, because you're talking about how China has been accumulating a lot of commodities and now controls a big portion of the world's supply. You didn't mention gold, but they probably have 15-20% of the world's gold supply as well?
I should think probably at least that. I mean, the history of it is fascinating. We don't actually know what goes on in China because obviously they don't tell us. But when you bear in mind that the regulations which gave the People's Bank the monopoly of dealing in gold and silver date back to 1983. So we're talking about nearly 40 years ago. What then happened was that China went through a period of capital inflows and then trade surpluses, which came out from the investment that originally went in. And if you look at all the flows backwards and forwards, it's perfectly possible that China accumulated at contemporary prices as much as 20 to 25,000 tons of gold. Now, we don't know this for certain, but think on this. In 2002, they then suddenly turned around and said that our citizens can now accumulate gold. They can buy it. And not only that, but they advertised the merits of gold ownership on, in the media, on television, and so on and so forth. And China has also very deliberately tried to corner the physical market. I mean, even if you look at the London Metal Exchange, the new gold contract there, first of all, the LME is owned by the Hong Kong Stock Exchange, and secondly, one of the major players is the big Chinese industrial bank, and they're dealing in gold on that platform all the time. So you can see that one way and another, their tentacles in terms of the physical gold market have just sort of gone all the way around the world, not just Shanghai, which is the largest delivery market of the lot. And furthermore, since 2002, we know from withdrawals from the vaulting system in the Shanghai Gold Exchange that the public have taken delivery of over 20,000 tons of gold. So, this is a huge chunk of the world's monetary gold, if we can call it monetary gold. I mean, a lot of it's gone into jewelry, obviously.
Well, it's still a form of savings, regardless how you fabricate it.
Absolutely, absolutely, and and I think the point about gold jewelry, both in India and China, is that not only is it a form of savings, but it is liquid. I mean, You know, they use it as collateral to, if you like, get next year's seed for the harvest. You know, this is goes on all the time. And if you go to Indonesia, it's exactly the same thing there. You've got networks of money lenders who use gold as collateral to advance credit to, everybody from poor farmers to, sort of people in business. It is a world of gold, which we in the West have actually rather forgotten and turned our backs on. And so I think, nowadays, the thing that's interesting is that we turn around and we think, the modern equivalent has got to be cryptocurrencies. But I've been trying to make the point that cryptocurrencies actually have a big basic flaw in them, and that is they do not share the legal status of gold and silver as money. Money is separate from any other form of property. If somebody comes along and steals your money and passes it on to someone else who receives it in, not knowing that it's been stolen, you've lost it. If, on the other hand, someone steals a painting off your wall and it changes through, a number of dealers and you eventually find it, it's your property still. So, and that's the big difference. And cryptocurrencies, I'm afraid, in other words, the rivals to gold, people who want to sort of get away from the old-fashioned idea of gold, just don't seem to take account of the fact that it is fundamentally different in this respect.
Yeah, there's another key difference too, that once you mint a gold coin, that gold is eternal. That nothing happens to that coin.
Absolutely.
But, yes. Cryptocurrency is being electrified constantly, and that in turn has vulnerabilities and costs associated with it that you don't find with gold. But just to put a good word in for cryptocurrencies, because we've discussed this many times in the past, I do see cryptocurrencies as a stepping stone. It's a way for the millennial generation to learn that there's something better out there than fiat, but they've yet to learn that the best currency is actually gold. And I think that's going to probably come to a fore as this currency revolution continues to gather force. Let's sort of wrap it up here, Alasdair. Is there any key point that you would like to make up in addition to what you've already said about this particular article and the currency revolution that's underway?
Well, yes. Virtually everybody I know is entirely committed to the world of fiat currency, fiat assets, and they have absolutely no insurance policy in case that goes wrong. And I think that that's a very unwise position to be in. I will admit that since 1971, the propaganda has been gold is a pet rock, gold is yesterday's story, it's not the future, and all the rest of it. And so for ordinary people, they have forgotten what gold is. They have forgotten that it's actually the only legal form of money. The rest is currency and credit. And there is a distinction there. It is the only form of money for which there is no counterparty risk. It cannot be printed by governments, nor can silver for that matter. Now, silver isn't priced as money. I mean, if you look at the gold-silver ratio, we're well over 70, whereas if silver was priced as money, we'd be close to 16 or something. So I would say that the one thing which I think people really should do is they should look at gold and silver, look at physical gold and silver, not paper representations, not investment representations such as mining shares and so on and so forth. That does a different thing. But just think in terms of how protected am I and my family from what is rapidly turning out to be the pricking of an enormous financial bubble in the West, which could take down the currencies. Yeah, sorry.
Yeah, no, it's a good point. And you've made a particularly good point about how we've lost sight, how the general world has lost sight of the importance of gold and what its role was. And it's something that, I've been calling the theory of natural money. Gold is natural money. Nature provides everything humanity needs to advance, including money, which is gold. Just like J.P. Morgan said in testimony before Congress back in 1912, that money is gold, nothing else. He wasn't defining what gold is. He was just saying what money is, and money is gold. I agree. And I think we're going to go through an education process because given that gold's been around for thousands of years throughout the development and advancement of humanity, that we're going to see gold come back to the fore in its traditional and rightful role at the center of global commerce. It's just a question of whether that revolution that we're going through now is going to be peaceful or it's going to be not peaceful, and hopefully it will be a peaceful revolution.
Yeah.
And that politicians and governments will come to their senses and realize that there is no money tree where you can print to infinity, because ultimately you just destroy the economy. Great speaking with you this morning, Alasdair, and maybe we can do this again at some time in the future.
I'd like that very much, James.
Great. Thanks, Alasdair.